Good morning, everyone. I hope you're all keeping safe and well. It is a real pleasure to be here today to present Imperial brands to you. I would just draw your attention to our disclaimer, which is available in the slide pack. I joined Imperial in July last year, and one of my first priorities has been to undertake a comprehensive strategic review of the business. We announced our new strategy 3 weeks ago, and full details are available on our website. Today, I will highlight some key elements of the strategy and then be happy to take your questions. This has been an opportunity to understand what has worked and what has not worked at Imperial in recent years, and to consider all options to create value. We've developed a strategy that is truly tailored to Imperial's strengths and focuses on those areas where we have a competitive advantage. In other words, it taps into the roots that made Imperial successful in the past. It is a strategy developed by Imperial for Imperial. Too often in the past, Imperial has been a follower, adopting strategies because they have worked for others, but they may not have always been the right ones for us. We can certainly learn from others, but this strategy is about ensuring we focus on our investment and resources in the areas that play to our strengths and make sense for our target consumers and our shareholders. So first, this is a snapshot of who we are. Imperial is a global consumer organization and the fourth largest international tobacco company, operating across 120 markets with around 27,000 employees. The fundamental financials are sound, with annual revenue of £8 billion, high operating margins and strong cash flows. And we have strengths and breadths in our portfolio with notable brands in all key tobacco and NGP segments. So we have some solid foundations to build on. Let me turn now to our new strategy to transform Imperial brands. We have developed a compelling 5-year plan centered around 3 strategic pillars and 3 critical enablers. Starting with the strategic pillars. First, a very clear focus on our priority combustible markets, where we will increase investment in our largest and most attractive profit pools through clearly defined operational levers to unlock value. Second, we will drive value from our broader market portfolio by managing these markets more efficiently through implementing global processes and sharing best practice. And third, in NGP, we'll be taking a very different approach, much more targeted and disciplined, driven by local consumer preferences. We'll focus investment on heated tobacco in selected markets in Europe and on vapor in the US. In order to deliver this plan, we're changing our ways of working and culture through 3 critical enablers. First, we will become a truly consumer-centric company, putting the consumer at the center of all our decisions. And to achieve this, we'll need to develop new capabilities and address consumer needs. Second, we are embedding a performance-based culture, one that holds our teams to account and rewards teamwork. Third, we will simplify our operations, which will realize savings to fund our investment plan. We provided lots of detail at our capital markets presentation, so today, after briefly setting out what our strategy will deliver, I'm going to focus primarily on the changes we're making to our combustible business, particularly with the new focus on our priority markets, as well as demonstrating our new approach to managing our brand portfolio. I will also briefly outline our new disciplined approach to NGP. I will then conclude by outlining the expected financial outputs and our capital allocation framework. So, what will our new plan deliver? This is a highly detailed plan that will significantly strengthen our business with a sharper focus behind tobacco and with clearly defined roles for our markets. Our commitment to harm reduction will be evident through our new targeted and more disciplined NGP business. We'll have an energized and motivated organization focused on meeting consumer needs with a culture that is collaborative agile and focused on delivery. Over time, this will lead to stronger, more consistent revenue growth and generate sustainable profit growth without requiring a margin reset in the meantime. And our continued strong cash generation, which is such an important feature of this industry, will provide the funds to support implementation of the strategy, debt reduction, and enhanced returns to shareholders through dividends and buybacks. This is a comprehensive plan for change, providing the opportunity to differentiate our approach from both our most recent past and from our peers to become a true challenger. Focus is the key theme running throughout our strategy. I want us to focus on selected battlegrounds and be more targeted with our investments. As a number 2 or 3 in many markets, we already have strong retail partnerships where our customers want us to succeed and provide good competitive tension. Becoming truly consumer-centric requires us to relentlessly focus on consumer needs at all times. And by virtue of our size versus our peers, I believe we can be a differentiated fast follower, providing consumers with greater choice in established categories. We are embracing our smaller size to become faster, more agile, and more responsive in our decision making. These changes to our culture and ways of working underpin my confidence in our ability to deliver a step change in performance. Throughout the strategic review process, we have considered our sustainability and ESG responsibilities and have concluded that both are aligned to our new strategy. Our sustainability strategy remains focused on tobacco, NGP, and behaving responsibly. With 5 ESG priorities, areas that have been validated with our stakeholders and are aligned with the United Nations Sustainable Development Goals. Some have questioned whether our more measured approach to NGP will deliver the improvements to consumer health. I firmly believe the answer is yes, because our disciplined approach will create a more successful NGP business, better able to attract adult smokers and thereby making a meaningful contribution to harm reduction. Let's now move on to our combustible business, which will be the biggest contributor to value creation over the next 5 years. The outlook for the tobacco value creation model remains positive. Overall, we expect pricing to continue to more than offset volume declines. Affordability is still good across our geographic footprint, reinforcing a positive pricing outlook. There is, of course, ongoing regulatory risk, but it's something we're well used to manage. Consumers are continuing to trial NGP alternatives, and we have an NGP offering to meet these needs. So, what will be different under the new plan? There are 2 key areas. First, it is about making some very clear strategic choices to direct more investments to our 5 priority markets, where we will allocate our resources and capabilities in areas such as marketing and regulatory affairs. For each priority market, we have a detailed plan with very clear operational levers. We've also defined a clear role for each market in the portfolio to optimize resource allocation. Second, it is about improved operational excellence. There's a significant catch-up opportunity for Imperial versus its peers. I don't believe the scale of this opportunity has yet been fully recognized by the investment community. This is about having better consumer insights, using data to inform decisions, and driving a far more proactive and rigorous approach to performance management. I've already implemented monthly performance reviews for the divisions and top 5 markets to speed up decision making. These are all straightforward initiatives, but they have not been implemented on a consistent basis at Imperial in recent times, creating an important opportunity. We will drive disproportionate investment focus on our 5 priority markets of the US, Germany, UK, Australia and Spain. These markets are our biggest profit contributors, representing 72% of tobacco profit. For the US, Germany and Spain, these are attractive and growing profit pools where we have scope to take a better share. The UK and Australia are highly profitable markets where we can drive a better operational performance to protect and even grow our position. For the rest of the combustible portfolio, this will be about more efficient resource allocation between the markets, with a clear role defined for each one of them. For our 5 priority markets, we have identified 6 operational levers to strengthen performance. This plan does not rely on a single silver bullet, but has multiple clearly defined levers at a local level, which we have grouped into these 6 themes. In cigarettes, our priority will be to increase our participation in the sub-premium segment, which has great margin and is a relatively stable segment. However, we typically under-index in this segment, with several brands that could play a more prominent role here. We also see opportunity to rejuvenate our local jewel brands and capitalize on the strengths of our local brand equity, and I will come back to this later. At the same time, we will optimize our approach to the value segment in cigarettes and in fine-cut tobacco, addressing the consumer trend for down trading in certain markets. The final 2 levers will enhance our channel and geographic coverage and also improve key account management. These 2 route-to-market levers are expected to pay back within a year, whereas the brand-related investments will require a little longer. Across these 5 markets, we've identified more than 25 growth initiatives and even more sub-initiatives. The plan is highly detailed, and so today I will just home in on an example from the US. The US is an attractive major market and our largest single market with very high affordability, supporting future pricing and value growth. In cigarettes, we are the number 3 with a 9 share and with a brand representation across the price tiers, with some strong brands such as Winston and Co. It is also a highly attractive mass market cigar segment with strong volume and price growth. We're number 2 in cigars overall with a good portfolio of brands. Also, we are number 1 in the fast-growing natural leaf segment with Backwoods, very well positioned as the market leader. Here, you see our framework of the 6 operational levers, and I'm going to share with you 2 great examples. First, it's about how we leverage the unique brand equity and positioning of Backwoods. The second is about driving performance by enhancing sales force coverage and effectiveness. Taking Backwoods first, with a great opportunity to build on its position in the premium natural leaf segment. We've identified the potential to extend Backwoods' regional presence into under-penetrated areas. Our investment program includes advertising at age-verified music festivals and comedy events, the use of brand influencers, and product placement in bars and nightclubs. These initiatives are building on a tried and tested engagement program, which has successfully been enhancing equity and awareness, and will support trial with smaller pack sizes and flavor extensions. Overall, we confidently expect continued strong top and bottom line growth with Backwoods. We've also identified a significant opportunity to enhance our US sales force coverage and effectiveness. We lag behind peers in terms of size and coverage, even after taking into account our smaller market share. There's a strong correlation between sales visits and market share, so we have already begun recruiting and training sales reps to increase our sales force coverage by around 25%. This will deliver a higher penetration, more in line with our relative market position, while also improving our outlet segmentation, ensuring the sales force are targeting the right outlets with the right service levels. We expect this to support our share with a financial payback within a year. So, by focusing our investments in priority markets like the US, we'll also free up resources from the rest of the portfolio, while recognizing that these markets have an important role to play going forward. Many of these smaller markets have highly attractive margins and cash characteristics, something that is unique to the tobacco sector. They also have more limited resource requirements, with some operated through distributor arrangements. Within the group, there are also some attractive market positions which we can leverage better to create future platforms for growth. For example, Africa, where there's strong unrealized growth potential with a supportive market backdrop. Going forward, we've defined a clear role for all markets to optimize value creation. We'll do this by ensuring our resources are effectively allocated, sharing best practice across markets, and developing future growth engines. We've also carefully assessed the opportunities for realizing value from selling parts of our portfolio, but in practice, the pool of buyers is limited. In addition, the significant antitrust constraints make divestments difficult or results in valuations that are unattractive. We've identified a small number of markets where the economics are not so attractive, and we shall selectively trim these over time through market exits. However, the majority of our smaller markets, in them there is a more value to be obtained from managing the assets better and through a more rigorous allocation of resources. We're also taking a very different approach to brand management, one which is more suited to the strengths of Imperial's portfolio. Imperial's acquisitive history has created an attractive portfolio of international and local jewel brands. However, we've often neglected the local jewel brands in favor of more international brands, and we embarked on a strategy of portfolio rationalization through brand migration. To be clear, some of our migrations made sense, but in many cases they did not recognize the strengths and value of these local jewels in our portfolio. One of the important changes is that brand portfolio decisions will be made at a local level, and markets can ensure they have the most appropriate brands to suit local consumer needs, whether they are international or local. This effectively puts the consumer at the center of the decision, rather than being driven from a manufacturing efficiency point of view. In addition, the variation of tobacco regulation by market means that product and packaging synergies are far more limited in our industry than in other consumer categories. Let me give you some examples of our new approach from Spain. Here, we are the number 2 player with some strong local jewel brands in our portfolio such as Noble, Fortuna and Ducados, which have good positions across the upper half of the price ladder. These brands have been neglected in recent years in favor of their international counterparts, and this has contributed to overall share losses for us in the market. So we're now beginning to leverage the full potential of these local jewel brands. For example, we have reversed the migration of Ducados into JPS, which has already delivered share improvements. We're also increasing our investment behind Noble, with a strong equity and national coverage. So, for combustibles, we have developed a comprehensive plan to strengthen performance over time. I would now like to turn to NGP, where we again are taking a different and more prudent approach going forward, one that plays to our strengths. Our starting point is the consumer, who is looking for potentially less harmful products. And our research shows that no product out there today consistently and fully meets the requirements of consumers. I want us to have a successful NGP business, one that delivers strong returns and can make a meaningful contribution to harm reduction. I believe we have the scale and capabilities to deliver. We understand the need of adult smokers and have a good portfolio of NGP assets. We also have strong routes to market and benefit from close partnerships with retailers in all our priority markets, where we can also leverage our regulatory capabilities. The key point for me to stress here is that this will be a very different NGP business. One that has realistic and achievable objectives, and one that will support the long-term growth aspiration of Imperial. So how are we changing our approach? Our business was focused almost entirely on vapor, where it launched too quickly across too many markets and without sufficient consumer validation. This resulted in poor investment returns. However, in vaping, we have some good brand equity and engagement in blu to build on. So we will focus on the US, the world's largest vapor market, and certain European markets such as UK and France. We will withdraw from markets where the market opportunity for vapor is less clear. In heated, also this has received only limited investment and rollout to date, with a promising product and technology in pulse. Our market research supports our decision to dial up the focus on heated tobacco in Europe, where we see untapped growth opportunities to meet consumer demand. And in modern oral, we'll continue to build on our established good position in Scandinavia and in selected European markets, with a tradition of oral nicotine consumption. So in summary, we have undertaken a realistic assessment of our NGP capabilities, both where we are today and where we can get to tomorrow. And Imperial has often focused too much on the product and its features, and not enough on the whole proposition for consumers, such as branding or consumer communications. The reality is, we have some promising products, but we can do much better at brand building and the way we connect with our target consumers. This has helped us to define a clear ambition that is right for Imperial. For us, it's about being a challenger, not a leader, with a differentiated approach founded on 4 principles. First, we will define very clear category market combinations based on consumer insight, a clear understanding of demand outlook, and the strengths of our existing routes to market. Second, we'll have a much more disciplined approach to investment. Initial investment levels will be modest as we drive targeted trials of our offer, grounded in research and consumer understanding. The success of our pilot initiatives will determine whether operations are scaled, and only if we are satisfied a growth opportunity exists, we will scale rapidly. Third, we'll no longer aim to create categories where demand does not exist today. Instead, we'll adopt a fast follower approach in markets where proven demand already exists. This is about providing greater consumer choice through a differentiated approach in those markets we choose to target. This is very consistent with what Imperial has been good at in the past. And fourth, we will refine our ways of working. For example, rather than trying to do everything in-house, we will leverage new and existing partnerships to enhance our innovation pipeline and route to market capabilities. So in summary, we have a clear plan for significantly enhancing our NGP performance, driven by consumer insights, a realistic ambition, a clearer focus, and stronger discipline. We have revised our category prioritization based on markets, category, consumer, and competitor insight, as well as a review of our assets, capabilities, and market footprint. Overall, our NGP operations will be much more consumer and data-led, and with more precision and discipline around investment. So I would now like to turn to what we expect our 5-year plan will deliver financially. We see 2 distinct phases. The first 2 years were about investing to strengthen the business, to underpin delivery of our new strategy and realize efficiencies. During this period, the additional investment, which will be partly funded by reallocating resources and the cost savings that are an important part of the plan will limit our growth in adjusted operating profit. In the second phase, you will see the benefit of the investment supporting improved profit delivery with mid-single-digit growth in CAGR over the 3 years. And the combustible business will be the main contributor to this profit growth. Revenue will improve gradually over the 5 years as the initiatives bear fruit, and overall, we expect to deliver a CAGR of 1 to 2% over the full period. The cash characteristics of our business remains highly attractive, with low capex needs supporting annual operating cash flow of more than 3 billion a year. Now turning to our balance sheet, the disappointing financial performance over the recent years has slowed the pace of debt reduction, as shown here. This led to the board's decision last year to cut the dividend to accelerate deleverage. Our credit rating with Moody's today is 1 notch above investment grade, the lowest among our major tobacco peers. We remain fully committed to maintaining an investment grade rating. Debt reductions will therefore remain a priority for the time being in order to achieve our target leverage, which is toward the lower end of a net debt to EBITDA range of 2 to 2.5 times. And a stronger balance sheet will provide greater flexibility for the future, improving resilience to manage uncertainties, increase our headroom with our credit metrics, and further underscore the defensive characteristics of our business. As part of the review, we've thoroughly explored and evaluated all aspects of capital allocation. My first priority is to strengthen the business by investing behind the new strategy. This is critical if we are to deliver the necessary performance improvements and rebuild trust and credibility with all our stakeholders. This will ensure the ongoing long-term success and viability of Imperial. Our second priority is to strengthen the balance sheet, to reduce leverage to the lower end of our target range, to underpin our investment-grade credit rating. Third, we also remain committed to a progressive ordinary dividend policy to provide a reliable and growing cash return to shareholders. Fourth and finally, our priority will be to return surplus cash to shareholders through buybacks. Given our current valuation, we'll look carefully at whether we could deliver a buyback with leverage higher than our target gearing. But we have concluded that at present, we do not have the headroom to fund a meaningful buyback without risking a credit rating downgrade. And the downgrade would seriously reduce future financial flexibility to implement our strategy and lead to significantly higher costs, significantly reducing the returns from any buyback. However, we will commence buybacks just as soon as our balance sheet and credit metrics allow. So what does this mean for investors in Imperial Brands? We now have a clear plan that will rebuild credibility and create value for our shareholders. Our revitalized tobacco business will be the most significant contributor to value creation over the next 5 years. Our NGP business provides an additional opportunity for growth and with better prospects for success, with a significant upside from self-help measures through operational excellence and performance improvements. In other words, just doing the basics better. And we have a motivated team of employees who are ready and willing to embrace these changes to make this a successful business. Most importantly, the business remains highly profitable and cash generative, underpinning enhanced returns for shareholders in the future. So thank you for your interest. I look forward to taking your questions shortly. Thank you.